Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and I'll be a monkey's uncle. It's Mr. Michael Becker at his own podcast.
Hey,
Michael,
Paul.
how are you?
Things are going well. I'm glad you made it to my office today, so it makes it a little bit easier to be on a few more of these.
Yes, we're going to have Michael, and we're going to have John Brixon in this podcast. We're going to have James, the Professor Eng, and Ricardo Hinojosa in the podcast today. We're going to be going around the table talking a little bit about what's going on in the capital markets. It's been really a funky time in the last, say, 2-3 months, guys, about what's going on. And so we want to give people who listen to the podcast just kind of an informative, educational breakdown about what some of the things that we're seeing. So before we get going, James, what is going on with the Old Capital Multifamily Conference?
Yeah, so we're about 3 weeks out on this conference, and so we'll probably have over 500-600 people at this conference. So if you haven't registered, go to oldcapitalpodcast.com to register and get your tickets. This week we got off a call with our keynote speaker, Lou Holtz, and he's one of these guys that cares not only about the conference, but he's coming out and delivering, a little bit more. He's going to tell his story, but then also learn some of his lessons that he took away from coaching, new teams every 3-4 years and taking them to championships and just really turning around players and really making an impact on their lives. So he's going to talk about doing the right thing for your investors, for your lender throughout the process.
What are the similarities of a guy like Coach Holtz versus, say, a KP or a general partner?
I mean, I love to compare a coach to being a general partner in that the general partner doesn't actually lease units. They don't actually repair any units, but they call the plays, right? So the coach is on the sidelines calling the plays. And the same way you as a general partner are calling in plays and make sure you have the right players on the field. And so Lou Holtz was never out there making one tackle, but he was calling the plays the same way that you're calling the plays, making sure you do the right CapEx, make sure you're doing the right property manager in the right seat. And so I think there's a lot of similarities to it.
So make sure you go to the Old Capital Podcast, oldcapitalpodcast.com to get your tickets. We'd love to see you. Again, this is not a regional conference. This is a national conference, and this is the once a year, and we do get a lot of investors that you have the ability to network with and get to know them a little bit better. So I think it's a good opportunity to come to Texas. So find a way, again, oldcapitalpodcast.com. So in the podcast today, again, John Brixon, James Eng, Ricardo Hinojosa, and of course, Michael Becker. And we're going to talk a little bit about capital markets. Again, I think it's an important piece right now. The lender brings 70, 75, 80% of the money to the table. And we just want to talk a little bit about what's going on in the marketplace. And I can't think of a better group to kind of talk through with you so you know what's going on to fund your transactions. So setting expectations is absolutely correct. So we're going to talk a little bit about what Michael's doing. And so Michael, everybody wants to be like Michael Becker. So just like when you're eating your Wheaties, be like Mike.
Very topical. That's good, yes.
So again, how many units do you guys manage right now at SPI?
Today, about 5,800 units today, and hopefully more in the not too distant future.
All right. So, but my question is, you're an operator in multifamily. You're really centric to the Dallas, Fort Worth, Austin, San Antonio area. I mean, you own properties up and down 35. And so tell me a little bit about what you're seeing today as an operator of properties. Are you looking at Fannie, Freddie, CMBS? How are you guys looking to get your transactions financed?
Yeah, I really appreciate it. About 3 weeks ago, you and James had this whole kind of state of the market, everything's falling podcast that launched about 10 minutes before Fannie and Freddie came back in the marketplace. So it's choppy, let's put it that way right now. Everything's evolving and changing, and everyone's trying to figure it out kind of on the fly, seemingly. Agencies kind of leading the I don't know what we're doing push right now as they're evolving. So, I think first and foremost, just having, competent and advice and someone there to advise you through these challenging times is certainly somebody. There's a lot of opportunity. There's still good debt out there, but having one of the old capital guys help you out, I think is certainly helpful, Paul.
So let's kind of talk a little bit about a transaction you're working on. Again, not everybody can be like Mike, but I want to throw it out there because a lot of people don't know other ways of getting transactions financed. So, Mike, just in broad terms, broad brushes, can you kind of walk through?
So we historically have done a whole lot of 10-year, 12-year fixed rate money lending, your typical kind of Fannie Mae DUS product. That's essentially what we did for the first 4 or 5 years of our career. And then we've been stuck a few times with some pretty large yield maintenance prepays that kind of limited our ability to exit a handful of these deals. So we've been focusing, trying to get a little bit more optionality and a little bit more flexible exits, particularly the last couple of years. So on the new debt we've been doing, that's been pretty important to us. So in the beginning of the year, we had a big push to do a little bit more Freddie because we historically have done a lot of Fannie. And Freddie had, we did a couple loans earlier this year. They were both 10-year term, 5-year IO. I mean, we got some pretty attractive spreads. So it'd be a floating rate loan, 30-day LIBOR is kind of your base, and then plus a margin. So we've been pretty big, and size matters in this business. So I think one of the deals we locked, we got a 156 spread. The other was a 178 spread over 30-day LIBOR. So as we record this, LIBOR is 2%. So one of mine is paying, basically like 3.5% essentially, or just a little bit over floating. And the way you kind of, with these loans, we agreed to a 2-year lockout, then it was par or 1% prepay after, meaning I can't pay my loan off for the first 2 years. And then starting the onset of the third year, you have a 1% prepay, Paul, to get out of the loan. So it allows a lot of flexibility that if I want to go out and, sell the deal or refinance it again, I'm just kind of tied to that loan for 2 years. So it's scary a little bit because you have not a fixed rate. So you have, a little bit of risk that if, we're wrong and rates move back up, especially the short term, your pay can go. So the way you hedge that is you buy a rate cap. And it was maybe like 3 or 4 weeks ago, we had JP on from Pensford. I would encourage you to listen to that if you guys haven't listened to that podcast, but kind of looking forward with the kind of the market's expectations of interest rates. I mean, it's basically for them to be flat to down for the next decade, essentially, is what the forward LIBOR curve's telling you. So these rate caps are exceedingly inexpensive. So you can hedge pretty much all your risk for a very nominal cost relative to the loan sizing. So that's kind of what we've done. And then that worked until it didn't work. And then about May, then Fannie and Freddie kind of had their cap issues and they started slowing the spigot. Then they effectively just turned it off overnight and they stopped doing loans. And then now they had a recent announcement. What was that, like late August, early September, that they're going to have $100 billion each for the fourth quarter 2019 through the 2020. So those five calendars, and kind of slowly turning the spigot back on and decreasing their spreads, because their spreads went from about 156, which was the lowest that we think we probably timed the bottom, and then we were getting that same basic deal would have been quoted about 250, so about a full percentage point or 100 basis points gapping out in the spreads or widening of the spreads. And then now I think the last deal we saw was maybe 220, 225 here recently, and I think we got an announcement today that they're dropping their rates on top of that, or their spreads on top of that here recently. So that's kind of coming in, I think, a little bit more to kind of where we were maybe this time last year. So we've alternatively done a few deals here recently where that caused us to go elsewhere. So your other two main options, especially if you have like A- stuff in primary markets, which is what the bulk of what we have, it's either going to be CMBS or LifeCo. And LifeCo, life company loans, we've been able to get a few of those. So I don't know if I've just rambled there, Paul. Do you want me to go more into that, or you have a specific question about it?
Yeah, I want to make sure that people understand is that some of the stuff we're going to be talking about is not going to be what Michael does. So I want to make sure that's clear. But let's put an asterisk to what Michael does. It is higher quality assets, larger transactions, more experience. It checks all the boxes that this product that he's buying looks more like an institutional property than it would be a class B minus, C plus, C property. So if you are trying to be like Mike, this is the way to get to what he does. And so these are properties that they're not value-added, large value-added properties. These are stabilized assets. They're going to get a rate of return almost from the beginning to the investors that put money into the transaction.
Yeah.
So give me some more details.
Yeah,
again.
so Lifeco loans, CMBS are kind of the other two primary liquidity points in the marketplace besides maybe some of the bank loans. And there's debt funds as well. So those are kind of the four things that are pretty active right now. We've got banks, Lifeco, debt, and CMBS on top of the two agencies. So, our assets are a little bit newer, a little bit nicer, and in primary market. So that's a good target for life company loans. If they were smaller, older, or in a secondary market, they're pretty much kind of excludes the life company loans. So you got to go CMBS. So if my deals were in Colleen or Tyler or someplace like that, life companies typically don't want to go there.
Again, what leverage point are you guys looking at right now on an acquisition or even a refinance?
So we're doing a refi. We got probably the most aggressive one out there right now, and we got up to 70% on a refi, and then we just got quoted as a bigger loan at $45 million. We got quoted a 185 spread over 30-day LIBOR with a 2.5% floor. So basically that gets LIBOR to 65 bips before you kind of hit the floor. So whereas earlier in the year, the Freddie loans we did had no floors. Now that these rates have dropped, all these lenders are starting to put floors in, and they tend to start a lot higher than that, and we were able to negotiate the floor down, negotiate the spread in, negotiate the leverage up a little bit. So it was a lot more flexible. That's one key takeaway, I think, kind of going through this versus kind of the other experiences we have with Fannie and Freddie is, you have some abilities to maybe argue a couple expense items or something along those lines, but they have their underwriting criteria, and they generally stick by their underwriting criteria. So Fannie and Freddie are a lot more formulaic, where with a life company or the CMBS, it's a little bit more flexible if you can make a sound business case. So that's one thing I have liked about it. The other major terms is we're going to get 5 years full-term IO. We'll have a 1 year lockout, meaning I can't pay it off for 1 year. Then it's par after, meaning no prepay after. So I have a whole lot of flexibility where, we can either have a second bite at the apple. So we can either refinance it again or we can sell it thereafter. But, generally speaking, they want to have a little bit lower leverage. I think most of these life cos really get aggressive around 65% leverage is where most of them kind of get super aggressive. And as you ramp your leverage up, you get your spreads gap out a little bit. I think if the same deal, if we would, instead of being 70, Paul, we would have been 60, we probably would have had about a 145, 150 spread instead of a 185 spread. I mean, that's some of the math we're doing when we're looking at these deals that we have. We could take a little higher leverage and maybe take, 50, 60, 70 bips higher on the spread, or you can lower your leverage and save that 50 to 70 bips on your spread. And then what does that actually do to your real returns? Because on a risk-adjusted basis, obviously it's better, it's lower risk to have the lower leverage. But if you're also paying materially less in interest expense, your returns on a real basis might not be that far off if you're going to go from a 4% pay rate to a 3.5% pay rate or something in those kind of lines. So those are some of the scenarios we're running out when we're looking at all these deals, because the spreads vary dramatically. Because what's like an average debt fund right now? One of what you guys have done at like 80% leverage. What would a spread be on that?
Like 285 over LIBOR.
Yeah. So on a bridge. On a
bridge loan, 285 to 300 over LIBOR, and we're talking 180. And if you're 60 leverage, it'd be probably 150. And so the spread's materially inside of kind of the full leveraged bridge debt right now, Paul.
Any questions, James?
Just real quick, after we did the floating rate interview with Pinsford Guy, a lot of people, we were looking at an 80s construction deal in Arlington, north of $20 million. And, instead of doing a Fannie or Freddie quote, fixed rate with yield maintenance or defeasance, everybody was like, well, just give me a floating rate quote. And it's like, all right, here's the floating rate quote. And it was at, instead of 75 to 80% leverage, it was 65 to 70% leverage. And so for someone like Mike, as long as you can go out and raise that additional 10% or 15% in equity, it's not a big deal. But for a lot of people, that's like $3 or $4 million in additional equity. And so people have to remember, as long as you can do that, you're good.
Yeah. Well, no, I mean, nothing's in a vacuum, right?
Right,
I mean,
yeah.
everything has a counterparty to it, and everything. You pull one lever, maybe it's like whack-a-mole, push one down, another one might pop up on you a little bit, but kind of depending on the size and quality, some of these nicer quality deals, you're not going to get to 80% leverage on a 2012 vintage deal most likely anyway. So, you're probably tapping out at 70. So my math is going to be, 65 or 70. And if it saves me 30, 40 basis points by lowering the leverage, maybe that math makes more sense. So those are some of the things we play with at least.
Yeah, and then one more thing. I don't know if a lot of syndicators are modeling prepayment penalties in terms of yield maintenance in their models. So if they do go to a declining prepay or 1% prepay and they're going lower leverage, and they compare that versus somebody who's just doing full leverage 10 to 12 year Fannie, the 10 to 12 year Fannie returns projected look better.
Yeah.
And not until you go to sell
So you have a
really
$3
see.
million yield maintenance.
Right.
Not in your model.
That was something that you had recently, right?
Say I went from 4 to 6, yes, and then we didn't sell. So yes.
Yeah, $4 to $6 million prepayment penalty. How'd you like to have that on your house? You'd live in that house for the rest of your life.
That's the bad news. The good news is we're going to make a lot more money, which is going to take us twice as long. That's what, at least that's what I'm telling people.
So in your mind, when you're thinking about this, I want you to kind of put a ruler out there. You got the 1 on this side, and you got a 12 on that side. And Mike is on the 12 side. And so I don't want to have confused you thinking that if what you can do is going to be completely different from what Mike does right now. You just have to go through 1, 2, 3, 4, 5, 6, work your way up to 12 on the ruler to be able to do what Mike is doing. But I wanted to just kind of focus in on that just for a little bit so you would understand of what some larger syndicators can do, what's available out there to kind of strive for on larger properties in better areas with lower leverage. And that is certainly some interesting stuff. Let's go back to that, to the left side of the ruler, not the right side of the ruler. So John Brixon, what's going on in your world these days that people would want to know?
Yeah, I mean, working on some interesting transactions right now. So right now I'm closing a bridge loan that'll be closing here in a couple of weeks. And this is on a property in the Atlanta market. And we've been hearing a lot about these online capital raising platforms where, people can basically post their property and then do a 506C regulation or a regulated equity raise and go out and raise, $1 million or $2 million. And so my borrower had used one of these capital raising online platforms in the past and had some success with it. And on this property, their plan was to use one of these platforms, and they basically had everything teed up. They were ready to go, ready to launch their property and go live with it. And at the 11th hour, this online platform, and I mean, really these online platforms, they're doing what's best for the investor. That's really their customer. And so they're going to dictate the equity terms and how they're going to raise the capital. But ultimately what they did is at the 11th hour, they said, you can do your 70 to 30 split with your 8% pref, but you can't take any distributions from the property until the limited partners have received 100% of their capital back. And that wasn't going to work for my borrower because that could mean that they're not getting paid until, year 5 or year 7 when they go to sell the property. And so at the last minute, we decided maybe we shouldn't raise the remaining equity through this platform. Let's find an alternative solution, which we ended up doing. Went out and talked to some different groups, spoke with a preferred equity lender that is willing to write $1 million loans or $1 million preferred equity checks.
Again, what does that mean? When I hear equity lender, that sounds like equity debt. What is that? I don't understand that.
Yeah, so I guess we'll call it the capital stack for an acquisition. You're going to have your senior loan, which will be your Fannie Mae or Freddie Mac loan. In this case, it was a bridge loan. And then behind that, you'll have the cleanest capital stack you'll have is just the first mortgage and then the equity. And so the equity would be all of your limited partners plus you. And then sometimes you might have what's called preferred equity layered in, where the senior mortgage is paid first, and then the preferred equity is paid back after that, and then the limited partners are paid after the preferred equity. And so what we had here was we had a group that was willing to write $1 million preferred equity check. They'd fund the $1 million at close, and then post-closing, my borrower would be able to raise their additional capital and pay down this $1 million line of credit effectively. And so it wasn't, I won't say it was a cheap solution. It was an expensive solution, but an expensive solution is better than no solution, I guess. And
what was the minimum loan size preferred equity piece that they would look at?
1 to 10 million.
So pretty low. They could go down to a lower number, but probably
Right.
higher cost and a lower number than it would be for a higher number.
Right. Higher cost. And this borrower had about 2 weeks to close. So they were looking at losing $300,000 or so in non-refundable earnest money.
Yeah.
So fortunately, what ended up happening was my borrower got on the phone and all hands on deck kind of situation, and called a lot of their past investors and a lot of people that they've worked with in the past, and they were able to pass the hat and raise the funds. And so we didn't end up using this preferred equity provider, but we had a term sheet and they were teed up and ready to go.
Yeah, but you brought them to the table. So I think what the takeaway is on this transaction is that the sponsor of the deal, they went out originally and they raised a bunch of money through limited partners, and that they came to kind of a stall point, and that they couldn't raise any more from their limited partners. So they were searching for a solution how that they would fill that gap between what they had raised and what the lender needed for them to put into the deal. And what you're saying is that you gave them some options to do it, but they saw that as a great solution, but they also said, hey, listen, maybe we can squeeze the turnip a little bit more and
Right.
pull some more limited partners money and maybe expand the pool of people that we've been using to get them to put more money into the deal. Is that
Right. Yeah, no, absolutely. And it ended up being really the best thing for the borrower and best thing for the lender. But, ultimately, obviously we're here to do the loans, but when things like this can happen, hopefully we can find solutions.
you are
and
a
help people out.
value-added type of guy? Very good,
Right.
John. Is there anything else on your list you're thinking here that we should talk about?
Well, I guess while we're talking about capital raising, maybe people can talk about what else they're seeing. I've seen, seems like more and more people are doing 506C rather than 506B type of syndications. I don't know if you guys have seen the same.
Before we go to 506B and 506C, I've actually seen some people come out and actually give limited partners the option between the sort of being preferred equity versus just being an LP equity on a normal deal. And so they're giving the preferred equity, let's say a 10% return, but that is in higher priority or higher preference than the other LP returns. And the LP returns are getting, let's say, an 8% preferred, but then they share in the upside. So depending on what your LP returns, or what the LP wants, they can choose what bucket to be into. And that might have helped your guy from the beginning. If he just did that from the beginning, he might have been able to raise $1 million in that bucket, in the preferred equity bucket, and then the rest in the, let's say, Class B.
Right.
Yeah.
Yeah, but they probably didn't want to pay that right from the beginning because they thought they would be able to take a vacuum and suck up all this limited partners money without paying a preferred to anybody. But then I guess that kind of bit them in the butt a little bit on that one. But a question that John threw out, what are you seeing for capital raising these days, and how tough is it? Talk with me, James, about what you're seeing in some of these transactions. Are they having difficulties trying to raise equity these days?
Yeah, I think that, just to make everyone aware, 506B is really, sophisticated investors and accredited investors. So the sophisticated investors and accredited need on the 506B a pre-existing relationship with you as a general partner. And then the 506C, everyone must be accredited, and they do not need a prior pre-existing relationship with you. And so we've seen people who are raising large amounts of money, I would say, over $5 million on an equity check, go with a 506C. But I've not seen smaller guys really using the 506C. Most of them are still using 506B.
We've kind of transitioned to do pretty much exclusively 506Cs the last couple of years, Paul, and that's just really a risk profile or risk mitigation strategy, because it's a lot less risk for you as a sponsor if you do a 506C, because there's certain safe harbors in there that as long as you go through these certain kind of steps to take reasonable steps to verify that everyone in there is accredited, basically meaning that we make them get a letter from a third-party source called Verify Investor that says they're accredited. I stick that in my file. And then if I ever get audited by the SEC or someone ever says I didn't have a relationship with you, that's more likely to happen potentially on a 506B, where that I have that piece of paper in my file, and that's a lot less of a risk profile as I understand it. So that's kind of what we've done. But I've seen, just kind of generally observing, Paul, a lot of these people out there are calling together, hey, there's like 5 co-sponsors to do this deal, and we all are going to kind of put it together. And I'm curious to see if they're doing it above board in compliant fashion, because I don't know. I'm certainly not a lawyer, certainly not a securities lawyer, but the way I understand it is everyone's got to have a defined role within the sponsorship team to take some compensation in the deal, and you can't be paid on performance, basically saying that if you raise $500,000, you get paid this much. If you raise $1 million, you get paid that much. And I suspect that a lot of these people are doing those structures are doing that exact thing.
Yeah, I definitely see that happening. I think there's just too many people that are on Facebook or different social media pieces that are putting that out there to get into deals, that they're just like bird dogs trying to raise the money, and they're trying to say to the sponsor, I'll raise $1 million and get me into this deal. And whether it's a compensation or it's a position within the transaction itself, it's still compensation to the deal. It's a great time now, but let's say a year from now or 2 years from now, when the economy's not so good and you're not getting your distributions of a limited partner, and one of the limited partners says, I better talk with an attorney and find out what my rights are in this deal, because I haven't seen cash in 18 and 24 months. I'm afraid at that period of time that they're going to open up, as they say, a can of whoop ass, and then you're going to have some difficulties trying to prove up that there was some flaws in it. You just don't want to get yourself in that position. Ricardo, tell me a little bit about what you're seeing. I mean, you're seeing a lot of the B and C properties. Are you seeing problems, capital raise out there these days?
It's going a little slower for especially the younger first-time, second-time leads. I don't know that we've had any major hiccups where someone just couldn't come to the table with what they ended up needing, but it is going a little slower. I would say over the last probably 9 months, 6 to 9 months. But for the most part, the capital's there. It's just first, second-time leads are having a little more trouble.
Tell me a little bit about maybe some of the rules that you're seeing either being implemented, that people that are thinking about buying a property, or maybe they own a property and they're thinking about refinancing it. They bought it maybe 2 years ago. They bought it for, say, $2 million, and then maybe it's gone up in value to $3 million or $3.5 million with all the work that was done on the property, and then now they want to take some cash out. What's going on with some of those rules?
So the cash out refinance is something we do a lot. It's a common exit strategy, right? Usually you're looking the first 3 to 5 years, you want some sort of a cash out, whether you may be selling it or refinancing it. A big change here recently, we're teeing up a couple of refis for deals that went in as kind of bridge loans, bank loans, and now we're looking at, so these are smaller deals, 3 to 5 million, and Freddie and Fannie are going through a little more scrutiny up front. Specifically, Freddie Mac has made some changes. Freddie Mac Small Balance has made some changes recently, where we're having to go in to sort of a pre-review process and really prove up the new valuation. So before it was really kind of a debt service coverage. It's got to be a 125. We'll cash you out 75% of the value. And now it's going an extra step on, okay, how did we get to that value? Was it, true net rental income appreciation, or was it cap rate compression? And the whole cap rate compression piece is what they're really trying to, get away from. So if you bought the deal 2 years ago, a C-class asset in Dallas, maybe 6.5, 7 cap. Today it's like a 5 cap. They're not going to give you all that upside. So they're going to look at, okay, where was the true appreciation in your NOI? But they're not going to give you that 2 points of cap rate improvement in the valuation.
Yeah, that is certainly true. Is that, up until probably a couple of weeks ago, you could get up to 80% refinance on a Freddie Mac small balance. Now, anytime that you have anything greater than 15% above the unpaid balance of the loan, it has to go into a review with Freddie Mac and let them figure it out. And I would tell you it's a little bit more challenging than what it was before. Is there anything else that you're seeing on right now or on the horizon that there's some questions on?
In regards to the refis, or just in general?
Just underwriting.
I think the big thing that we're running into right now is the changes in credit criteria. Fannie and Freddie, for example, IO. 6 months ago, they were a lot more lenient on IO. For Fannie Mae right now, if you're at max leverage, 75, 80%, you're getting 1 to 2 years. Now, if you ratchet down the leverage, 65, 70, 75, then you can get a little more IO. But they're getting really tight on the interest only on these deals.
Mm-hmm. I'm going to bring this over to Michael. Anything else that you're seeing on the horizon?
I haven't noticed. It's just been kind of like the tectonic plates have shifted a lot about 4 or 5 months ago when the agencies kind of just slammed on the brakes. I'm curious to see kind of how going forward the green program's getting. I know it's still around, but is anyone actually ever going to do the green program again until? So I'm not quite sure how much economic incentive they're going to put in there, because it just didn't really make as much sense when they tightened up kind of the requirements on how much savings you had to do, which really kind of ramped up the cost. So then if they were going to give you 40, 50 basis points break on your spread, it made economic sense to do it. But if it's no break or 5 or 10 basis points break, I'm really curious to see how much green actually gets done on a go forward basis, because there's real hard costs on the front end of these deals to put in your toilets or aerators or whatever else you have to do to the property. So I'm curious to kind of see that, but it seems like the spreads kind of gapped up and they're starting to come back in, and I think I don't know if we get all the way down to where the trough was on the spreads, but I think we'll probably be back to kind of where we were to start the year in the not too distant future with the agencies, because it seems like they had that $20 billion a quarter for the next 5 quarters, being the fourth quarter 19 throughout 2020, and at their current pace, I think they're going to do like next to nothing each in the fourth quarter, and I think they're going to wake up come Christmas time saying, "Oh crap, we got to get this money out the door." So I think there's some relief coming. That's my crystal ball. We'll see kind of what reality turns out to, but I think both Fannie and Freddie are about to get a lot more aggressive on the spreads here pretty soon, because the life companies and CMBS have really kind of stepped up and backfilled a lot of that void that was there.
So, James, you've been taking notes fast and furious here. So let's hear some of your impressions about what's going on. I always like to listen to James, what he thinks, what's going on now and what's going on in the future.
No, when we were at a conference yesterday and they had a guy from Fannie and a guy from Freddie, and I mean, the green program, they didn't have anything to say about green. I mean, it was just like, it's not even part of their sort of mission, I guess they kept using in terms of, so they got $20 billion a quarter, both of them, but then also 37% has to be sort of mission driven or affordable. And they think they can hit that just doing the deals that they're doing right now. And so the green was always sort of on the side, but now since they're not going to be pushing it, you might get 10 or 15 basis points off right now, maybe 20 basis points, depending on the deal on green. But unless there's still, you can still do the report. I mean, I think they're reimbursing people still for the report, so you can run the report, but maybe don't count on getting that interest rate savings, because if it's $200,000 on your $5 million deal, you're not going to do it. And then on the CMBS side, what I'm seeing right now is they're still really aggressive on deals, and the spreads were lower than Fannie and Freddie. And so we had a client who they're looking at holding a deal probably for 5 to 7 years, and it was in a secondary market, and so they elected to go with CMBS, and CMBS is going to close in like 25 days, and they had the equity already raised coming out of a 1031, so they were happy with the execution. The one question they had was the lockbox, so they had never really worked with a lockbox, and so that probably took the longest time.
What's a lockbox?
A lockbox is essentially the lender sets it up before the deal closes, and there's all different types of lockboxes, but it's really just a bank account that the lender can control if your debt service drops below, let's say, a 115 or 110, and the lender can all of a sudden control that money very quickly. And so for a lot of CMBS lenders, they want this in place so that if debt service falls, all of a sudden they can control the deal a lot easier. So they set it up front, and a lot of times it's the money goes in, and then it's swept into your operating account every day if there's no issues. But the moment that your debt service starts falling, or like in office, retail, you lose a big tenant or something like that, that lockbox all of a sudden pops up, springs into action, and the lender has control of a lot of the money. So the money goes in, they pay themselves first in terms of principal and interest. They might pay taxes and insurance, and then the rest of the money will go to you after that. So they're making sure they get paid, and they might hold some of that money for collateral as well. So just be aware of that.
Yeah, and CMBS, maybe a good solution for office and retail. because it can be a 30-year amortization, 10-year term. But for multifamily, probably not a great select choice unless
you want to go to like Midland, Odessa or something. That'd be a good choice there, but short of that, not so much.
Why is that? Why would that be the reason?
Because these are securitized loans, and they just go out into Wall Street basically and securitize it, sell it effectively as a bond, where like Fannie and Freddie also securitize, but they have risk sharing agreements with their DUS lenders, and Fannie and Freddie, in particular Fannie got extremely concentrated, like in a market like Midland, Odessa,
right.
Which is like a one horse town, which is as oil goes, so does Midland, Odessa, and so they don't want to keep doubling down. So if you want to go there, they're gonna not give you new money. They might put a refinance or do an acquisition loan on a property they already have an existing loan on, but they don't want to increase the exposure. So those are where CMBS comes in and plays a little bit better than you're not going to do that in downtown Los Angeles or something, because there's plenty of lenders that'll go to a primary market like LA or Dallas or Phoenix or someplace like that.
And just make sure that when you do underwrite a CMBS transaction, it's not with pro forma income. We got to use actual income. The actual income for last, say, trailing 1, trailing 3, trailing 6. We can use pro forma expenses, making sure that it does make sense, that the appraisal will use it. We saw a transaction out in the secondary market too, not the one that James is talking about, but another transaction that the operator on the property was at like $2,000 a door on expenses, on annual expenses, and that the CMBS lender, which is absolutely incorrect, used, say, that $2,000 a door in annual expenses. It should be almost twice that. And so that's how they did a term sheet. And now we're waiting for, we didn't execute on that deal, but we're waiting for the appraisal to come back and to support that you cannot use $2,000 a door in expenses, that that loan amount is absolutely incorrect, and that you're going to get retraded. So make sure you see the underwriting on these CMBSs and how they're getting there to give you those, say, the higher leverage or those lower rates. So whatever sometimes appears to be too good to be true is actually not even close to being true. So James, what else?
Mike was on a panel yesterday at this conference, and I thought it was pretty interesting. There's a couple guys on that panel that were sort of in different, phases, I would say, be like Mike phase versus there were some guys up there with, 10, 15,000 units on the stage. And I thought it was interesting. One guy, he was talking about they were actually recapping a lot of their deals instead of selling.
Yep.
And so the general partner...
What does that mean when you recap a deal?
So let's say you initially raise the money with a group of investors, and then that investor, it might be one guy who wants to go out of the deal, but the general partner wants to stay in the deal. And I thought it was pretty interesting because they were able to go out and find either another big limited partner or a group of limited partners to come in and replace the original limited partner, and the general partner stayed in the deal, and then that allowed the deal to cash flow, I think, even better. They probably could have put better debt on the property and then potentially did not cause a reassessment on property taxes, which I thought was pretty interesting. So I don't know, Mike, anything else from that panel that you remember? I know it's hard to listen while you're up there and remember everything, but I thought that was pretty interesting from that perspective in that doing a recap instead of just selling the deal outright.
Yeah, that's something we're considering on a few of these deals too. That, if you like the deal, everything about the deal, why get out of it, but your partners want to get a return of their money because you're 3 or 4 or 5 years into the deal, and that was your original plan. So it's basically just like swapping out the equity in the deal. So the tricky part is like, how do you get everyone to get comfortable with that one side's not taking advantage of the other side, the buy side and the sell side, and you as a sponsor is kind of in the middle. So making sure that you can justify whatever valuation you peg the recap at is fair and to market. So I think that's certainly a viable way to exit some of these things. There's they keep saying the term, I think, is wall of capital coming at multifamily, and it's here today and it's going to be there in 2020. So that might be a viable way to exit a couple of these deals versus just straight up selling them if you guys are looking to get out of it. So, but be careful a little bit, because sometimes, you swap out some friendly equity and maybe get a little bit less friendly equity and get a little more hurdles and troubles that you gotta deal with. And so just go in it with your eyes open if you're going to go down that path, I think.
Yeah, and the only other thing that same guy mentioned was he was going to turn his 17,000 units into a REIT, which I thought was super interesting in that he compared it to, most of your limited partners returns we talked about, they want 7, 8, 9% preferred returns. And then once you turn it into a REIT, they only want 3 or 4%. So guess who keeps the difference? So It's pretty interesting.
John, what else is going on your plate?
Well, I guess just going back to the CMBS, and I get a lot of questions about CMBS, and what about CMBS? Could we do a CMBS loan here? And it's been interesting. I've gotten quotes on a few properties from CMBS lenders, and the spreads have definitely been a lot lower than the spreads on Fannie and Freddie. But what I've found is that in terms of the loan proceeds, so CMBS lenders, they'll, just like Fannie and Freddie, they'll look at debt service coverage, and they want to be at a 125 or 130 debt service coverage. But what's different is they look at debt yield. And what debt yield is that's it's NOI divided by the loan amount. So it's almost like a cap rate, but for the loan. So for instance, you have a property that's generating $1 million in NOI, and you're putting a $10 million loan on it, you'd have a 10% debt yield. If it's a property that's generating $1 million in NOI, you put a $20 million loan on it, that's a 5% debt yield. And so what I've seen is that CMBS lenders, they're pretty, one way they stay disciplined, they really kind of check themselves is on multifamily, and maybe I'm wrong, or maybe I'm, but based on what I'm seeing, they'll only go down to like a 7.5% debt yield. And in the DFW market, a 7.5% debt yield, it really doesn't get you that much loan dollars. You get up to 70, maybe 75% LTV. And then on lower, on older properties, like a 1960s vintage or 1970s vintage property, they're not really going below an 8 debt yield, and like maybe get to a 7.75. And so I've gone and gotten CMBS quotes on some multifamily properties, but it just hasn't really penciled out because of the debt yield constraint.
So let me walk you over to secondary markets.
All right.
So that's why, the deals in secondary markets, they're not buying at 5% caps like in DFW. They're buying them at 7 to 7.5 caps, and so the debt yield is 8, 9, 10% on a lot of these deals. So they're getting the 75% sort of max leverage out the door that CMBS can provide, and so that's the main difference. But the pricing, what's ironic is that the pricing on a lot of CMBS might be lower than a Fannie deal in Dallas right now, which, yeah.
What else are we seeing out there, John?
And seeing, a good amount of bridge loans still. I think there's people who are buying properties where there's a clear path to higher net cash flows, and they believe that path they can execute on it. And so kind of like Mike was alluding to earlier with the high yield maintenance and the high prepayment penalties, people are saying, I believe in this business plan, I believe in the property, so I'll finance it with a short-term loan or a balance sheet loan, and then I'll be able to do a cash-out refi 18 to 24 months later.
And you are seeing non-recourse bridge loans out there, and where do they usually start at? If somebody wanted to pay for a property, where do you see the loan amount start at in leverage?
Yeah, it's the non-recourse bridge loan market. The larger you go for bridge loans, the more liquidity, or I guess the more options there are for borrowers. So, above $10 million and up, you can get a non-recourse bridge loan at L plus 285 to 300. And then for a loan that's in the $5 to $10 million range, which I have a signed loan application on something today, it's about a $6.5 million bridge loan, and that's at L plus 315. And part of that is just because it's a smaller loan amount, and a lot of these bridge lenders, it takes just as much work to do a $7 million bridge loan as it does a $20 million bridge loan. So they want to get paid for lower dollars. And then in the $1 to $5 million space, it's even less liquid, or there's even fewer options. So in the $1 to $5 million space, it's either go to a community bank, and if it's a community bank that prices on LIBOR and not on prime, you can get a pretty good rate. Or if you go to one of those, there's a lot of these lenders that were fix and flip single family lenders, and now they've gone into smaller multifamily, and they'll do 80% of purchase up to 100% of rehab on a very small property, but their rates are 7.5% to 8% fixed.
Yeah, minimum on something like that.
Right.
Yeah, so they're trying to get into the multifamily space, but sometimes they may be a good solution on smaller transactions. Ricardo, what else are you seeing in your world these days?
Well, just to add a little bit to what John was mentioning, is that we are doing a whole lot more bridge. At least over the last, I would say 6 to 9 months.
Yeah.
Doing a lot more bridge.
So out of 10 transactions, how many are bridge transactions?
Well, I would say a year ago, out of 10, it'd be maybe 1 or 2, or about 2 to 3 years ago, 1 or 2. And now it's maybe 3 to 4. And then the rest primarily are Fannie and Freddie. And then you sprinkle in a little bit of, the small bank deals. But the reason for that, I guess from my perspective and a lot of my clients, is leverage is such a big deal. But the watch out is you've got to have that upside. And we've had some bridge lenders on here recently that talked a lot about hey, we'll go up to 80, but we've got to have a really strong sell story. But I get a lot of calls where it's more of a yield play, and investors are coming in, okay, how do I get 80% leverage? Well, the deal doesn't size for 80% leverage. Why can't I do a bridge deal? The risk reward is just not there. You really shouldn't, because in 2 to 3 years, you're going to have to be able to exit. And that story's not there. So just the story has to be there, and it's got to make sense. At the end of the day, the key thing is engage us early, and let's talk through these things. Like Mike said earlier, things are changing so quickly. I mean, it seems like every week we get new news in terms of what Fannie and Freddie are up to. So just stay tight with your lender and know what's going on.
So James, I'm going to ask you this question: is that, you are very good, John is excellent, and Ricardo is the best. So why would we be losing transactions? Why do not some people use Old Capital? As much as we try to do every transaction, what are you seeing out there about why some people sometimes, I think, would regret not using us?
We had a podcast probably 9 months ago about listing brokers having sort of 2 hands tied behind the borrower's back to some extent in terms of people wanting them to use their lender. And so, we've lost some transactions that way. And then also, a lot of times, my background is in underwriting. A lot of these guys around the table spend a lot of time underwriting deals. And we want to present a term sheet that is as close to real life as what we can deliver versus giving you something. What we don't want to do is give you a term sheet at, let's say, $8 million and then tell you 30 days later that actually we're going to come in with a $6 million loan. Because you already bought the deal, you paid $10 million based on an $8 million loan, you thought you'd get 80%, and then now all of a sudden we give you a $6 million loan and you're at 60%.
That's exactly where I'm coming from, is that a lot of people will put term sheets in front of people and some of these people may work for lenders and they still don't know. And a lot of these direct lenders, so to speak, they won't underwrite the deal. They won't go around the table making sure underwriting has approved the deal. They haven't talked with the appraiser to figure out what the real numbers are on the deal. They haven't maybe driven the property, kind of see what's going on. As I can tell you, we check all the boxes. Before we issue a term sheet, we know that we're going to be either right there or pretty damn close to what that number is going to be. John?
Yeah, I have a pretty funny story as it relates to this that we've encountered so much with listing brokers really trying to force people to use their lender or their mortgage banker on the financing. So I'm working on a loan right now that's in the Kansas City market, and we're closing in a few weeks. So, knock on wood, it's not a done deal yet. But basically what happened was we're financing it with a Freddie small balance loan, and a little bit opposite of what you were talking about, Paul, where a lot of times these listing brokers and their lenders, they'll dangle an 80% term sheet in front of you that they really can't deliver. Well, in this situation, we actually were sizing and we were getting to 80% on this loan. And this listing broker was still saying, hey, you've got to work with our guys, even though we're not getting to 80%. Old Capital's full of they can't deliver. And so I'm talking to my borrower about it, and we've spent a lot of time on it. We've underwritten the transaction. Old Capital, we've probably closed dozens of Freddie small balance loans in the last couple of years. And so finally, I tell my borrower, I said, hey, ask this mortgage banker how many Freddie small balance loans they've closed in the last year. So they asked them, and the mortgage banker said, actually, we haven't closed any Freddie small balance loans in the last 2 years.
And this is a direct lender.
Well, it wasn't a direct lender. It was a group that was saying that they had a Freddie license, but they didn't have a Freddie small balance license.
Oh, I see.
And so ultimately what we ended up doing is we said, look, let's issue a loan application. You can sign the loan application, lock in the rate, if this lender can deliver a term sheet that you think that they can deliver on and it's better than us, you can terminate our loan application, walk away from it, no hard feelings, whatever. And so luckily we signed the loan application, rates shoot up 20 basis points that week, and they end up moving forward with us. And then finally they tell the listing broker, once they've signed the PSA and they have it under contract, they tell the listing broker, hey, we're working with Old Capital. And the listing broker wasn't happy. And, I think if I was buying a property, I'd probably be more transparent with the listing broker and say, look, I have a signed loan application. We're moving forward with this group. Let's move forward. But and it's hard for me to believe this, but they really felt like the listing broker was going to pull the deal from them if they didn't use them for the financing, which...
And that's something that we do see is that the listing broker is passionate about trying to get the loan application to go with them or one of their affiliates because they're getting paid. So not only are they getting the listing commission in the transaction, but the lender's going to pay them a good sized commission on the deal too. So that's why they're so passionate to use their group inside their company or something like that. We kind of like to keep a Chinese wall, so to speak, between church and state and making sure that we're doing the right thing for you and that there's no outside influences on anybody in the transaction that would affect you in your borrowing. Michael, anything more to go before we leave?
Yeah, I think just kind of talking a bunch here lately, just kind of always in the marketplace. It feels like we're finally starting to feel some gravity again, like we felt like for 3-4 years. I've been saying don't buy in the hood and don't buy old crap in bad locations, and I've been wrong because people keep making more and more money. But finally feels like gravity's setting in a little bit. So be careful with what you're buying, where you're buying, who you're investing with. You buy a first timer with a tough property in a bad location, it might not end well. So I've said that 4 years ago and I was wrong, but at some point I'm going to be right. And I think that day's sooner than later.
Absolutely. So some great information that comes from the team here at Old Capital. Again, we do this on a quarterly basis. We kind of go around the table. We'll bring in some additional loan officers that you can speak with maybe next time with Old Capital and just get their perspective too. So we appreciate everybody being here. Michael Becker, always a pleasure. Thanks for being on your podcast.
Thanks for having me.
John Brixon, thanks for being here. James Eng, the professor, appreciate that. And Ricardo Hinojosa, thanks for being here. Again, if you have any questions concerning any financing of apartments, go on to oldcapitallending.com. oldcapitallending.com. And again, if you think we bring value, we're trying to get 1,000 likes on our iTunes page. Do us a favor, go into iTunes and give us a 5-star rating. We would appreciate that.
We have more than 1 million downloads now, Paul. If you notice that or not, but it's been amazing to see all the growth. So definitely appreciate all the listeners.
No, we definitely we appreciate everybody listening. So we appreciate that. Again, thanks for listening. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.